In Ireland, it's a legal requirement to have a mortgage protection policy if you have a mortgage. The most common policy sold for this requirement is what's called a mortgage protection policy, which is a decreasing term policy. What's a decreasing term policy? It does exactly what it says in the tin. Cover decreases over the term. So if you have a mortgage starting at €300,000 over 30 years, in 30 years' time, your mortgage is going to be zero, which is great news, but also your life cover or your decreasing term policy is also going to be zero. The better financial planning product to use for covering your mortgage is actually called a convertible term assurance policy. So what's the difference between decreasing term and a convertible term policy? Well, simply put, one decreases while the other one stays the same level. So what's level term assurance or convertible term assurance? As I mentioned, it stays the same. So if your mortgage starts at 300,000 and your mortgage is 30 years, in 30 years time you'll have no mortgage outstanding, but you're still going to have 300,000 more to cover. Most importantly, if you die during the term, say 15 years into the mortgage, you might have 170,000 left on the mortgage. You'll get a 300,000 payment. The €170,000 will clear the mortgage and you'll get the additional €130,000 for your estate, which is really important, obviously, if you have children. So which one's best? Well, it depends on your situation. It's a case-by-case basis. Technically speaking, I think the convertible term assurance policy is always going to be better because it puts the favour in your court rather than the life company's court, i.e. it gives you more chance of getting money back after a policy if you're paying for 30 years. The convertible part of this policy is also exceptionally important. After 30 years, at the end of the term, the life company must give you terms again for another 30 years, depending on your age, and also it doesn't depend on your health. So you could have a really serious health complaint, but the life company must give you cover again, and that's the convertible part of the term policy. So my financial opinion, the best policy is always going to be a convertible term assurance policy, slightly more expensive, and the only reason I'd ever think or consider putting on a mortgage protection decrease in term is maybe if you're going to have an investment property mortgage. But that's really it.